If you paint by the numbers, growth in the world's second largest economy is back on track. China's third quarter GDP grew 7.8% in the third quarter of this year after slowing in the first half, and putting China well in range to hit the government's growth target for 2013. Pretty good if you look at China's growth rates compared to the rest of the world. But underneath the surface, massive changes are at play in China's economic formula, moving away from a dependency on exports and manufacturing and towards consumer consumption as the main driver of growth. It's a long-term plan, and many experts think the current bump up in growth will be temporary. Retail demand in certain pockets of China's economy looks sluggish. Take consumer footwear, for instance, where homegrown companies such as Bell International are seeing weak demand. Andrew Economos of JP Morgan.
So I expect over time, and perhaps not soon, we'll start to see, maybe in the next 2 or 3 years, we'll start to see a deceleration in GDP growth to another slower but more sustainable growth trend of perhaps 5 to 6%.
China's authorities said they will accept slower growth as part of a transition to a more developed economy. But worries over China's declining exports are causing some concern for global trading partners. Trade with Southeast Asia has fallen sharply despite a diplomatic push by China to improve relations. A stumbling China could hurt a region and world which are increasingly economically intertwined.